All right, in this video, I want to talk to you a little bit more about how you utilize the all-in-one loan as part of your cash buyer strategic planning. Now, it's important that we have this conversation before you go ahead and pay cash because it will likely provide you greater options and financial flexibility. In short, let's say you're buying a home for $800,000 and you're intending to pay cash. We would set up an all-in-one loan at the time of purchase for 80% of that purchase price, $640,000. This would mean that you put down $160,000 at the time of purchase, and then once the loan is set up, you put the other $640,000 into your all-in-one account. This will leave you with an offset mortgage balance of zero, so no mortgage payment needed, and effectively you've paid cash. So why do this? Well, unless you have access to a crystal ball, there's no way for you to know what the future holds. I've seen some of the wealthiest, most financially secure people you could imagine purchase a home and pay cash and then find themselves in a situation just a few years down the road that they never could have possibly imagined. The ability to access all that cash without any hoops or hurdles to jump through, that can literally be a lifesaver. You just don't know what the future holds. So the number one reason I recommend this is your financial protection. So why not just do a traditional HELOC? Great question. And there's two reasons. First, a traditional HELOC has a draw period of 10 years versus the all-in-one has a draw period of 30 years. From the simple aspect of probabilities, the odds of you having an unforeseen financial need within the first 10 years are significant, but the odds of you having a financial need in the next 20 to 30 years increase exponentially. The second reason is that a traditional HELOC, even within that first 10-year period, runs a risk of a line reduction. And this happened to many homeowners after the market collapsed in 2008. And the reasons for that are twofold. One, banks and investors wanted to limit their exposure based on the lower housing values that we saw. Second, one of the tools that the Federal Reserve has available to them to control money supply is to raise the reserve requirements. We're all fairly familiar with the Fed either raising interest rates or lowering interest rates to spur the economy or slow down the economy. However, the other tool that doesn't get talked about widely is the fact that they can change the banking reserve requirements. They can increase or decrease those. So what happens is when the Fed increases the reserve requirements, that means the banks have to hold on to more cash rather than lending it out. Well, if they increase the requirements and there's an outstanding equity line available, but it's not being utilized, they have to hold cash in reserves for that. And that amount goes up when the Fed increases those limits. That means that the bank will turn around and start calling on those homeowners that have unutilized lines of credit, and they will reduce those lines so that the bank can lend out more money to other borrowers. So that's what happens with a traditional HELOC. The all-in-one loan is not a traditional HELOC. It's a mortgage combined with a checking savings account. And so that checking savings account is where your funds are going into, and that's being utilized to offset the interest that you're being charged on a nightly basis. But you still have access to those funds just like you would if you deposited them into a checking savings account. With the all-in-one loan, your funds are there and available to you 24/7 by way of an ATM Visa card, standard checks, wire transfers, mobile banking, and ACH payments. And going back to what I said earlier, the number one reason that I recommend the all-in-one is for your financial protection. The second reason I recommend it is because it provides you tremendous flexibility when opportunities arise. I have personally seen my clients utilize the all-in-one loan to fund real estate investment opportunities, to dreams and projects they never would have had any other way to safely fund. I also know from years of experience that many clients will try to pay off their home prior to leaving their jobs in corporate America. Then they end up going off to start businesses in their retirement that often become very successful. However, they typically have great CPAs who help them limit their tax liability. They never thought about it when they originally paid off their mortgage or purchased their retirement home that someday they may want to buy a second vacation home. However, because of their tax write-offs, they don't have the ability to buy the home they want when they want. Those clients who have an all-in-one established have the ability to simply make an all-cash offer. And that allows them to negotiate a great deal, plus provides themselves excellent financing terms. I believe the all in one is the greatest financial tool for helping homeowners pay off their mortgage, but it's also a great tool for providing you incredible flexibility, both for unforeseen needs as well as potential opportunities. Everyone's financial situation is unique. If you'd like a mortgage coach in your corner, I'd welcome the opportunity to be a sounding board for your scenario. There's no cost or obligation, and as many of my clients will tell you, it's definitely worth the time to explore your options. So shoot me a text at the number below and let's schedule a free consultation. I look forward to hearing from you.